How the stock market works, explained simply. Ever wondered how people make money from stocks? Or why the news goes crazy every time the market moves up or down? Welcome to our beginner-friendly breakdown of how the stock market really works, explained in simple human language. No jargon, no stress, just the basics you need to understand one of the world's most powerful financial systems. Let's get into it. What is the stock market? The stock market is like a giant global marketplace. But instead of buying fruit or clothes, people buy and sell ownership in companies. These little pieces of ownership are called stocks or shares. When you buy a stock, you own a small part of that company. If the company grows, your share becomes more valuable. If it struggles, your share can lose value. It's that simple at its core. Why do companies sell stock? Why would a company give away part of itself? Simple. To raise money. Let's say a tech startup wants to expand. Maybe build a new office, hire staff, or launch a new product. Instead of taking a loan, they go public by selling shares on a stock exchange. In return, they get cash, and you, the investor, get ownership and a chance to profit if they succeed. What is a stock exchange? A stock exchange is where all the action happens, like a digital marketplace where stocks are bought and sold. Examples include the New York Stock Exchange, NYSE, NASDAQ, London Stock Exchange, and others around the world. These platforms connect buyers and sellers and make it possible to trade stocks safely and transparently. How do you make money in the stock market? There are two main ways people make money from stocks. Capital gains. This is when you buy a stock at one price and sell it at a higher price. Buy low, sell high. Classic investing. Dividends. Some companies share a portion of their profits with shareholders. You get paid just for owning the stock. Example, if you buy a stock for $50 and sell it for $70, that's a $20 profit per share. Not bad, right? But what about losses? The stock market isn't a magic money machine. Prices go up and down, and sometimes you lose. Stock prices are influenced by everything: company performance, economic news, interest rates, politics, even social media. A single tweet can move markets. That's why risk management is key. What drives the market? Markets are driven by supply and demand. If more people want to buy a stock, the price goes up. If more want to sell, the price drops. But investor emotions also play a huge role. Fear and greed. A hot stock can skyrocket because of hype, while panic can crash prices even if a company is doing fine. How can you invest? Today, it's easier than ever to invest. With apps like Robinhood, eToro, or traditional brokers, you can buy stocks from your phone. But before you do, remember, do your research, invest only what you can afford to lose. Think long-term, diversify. Don't put all your eggs in one basket. Final thoughts. The stock market might seem complicated, but at its heart, it's just people betting on the future of businesses. Whether you're in it for long-term wealth or just curious, understanding how it works is the first step. You don't need to be rich to start, you just need to start smart. What's one company you'd invest in if you could buy stock today? Let us know in the comments. Don't forget to like this video, subscribe for more finance and life simplified content, and hit the bell so you never miss a money smart moment.